welcome to the FII View with me, Tanveer Gill. My guest today on the show is Richard Titherington, who is the Chief Investment Officer and the Head of Emerging Market Equities at JPMorgan Asset Management. Over his career spanning more than 20 years, Richard has served as a US and international pension fund manager as well. In one of his recent views on emerging market stocks, Richard has asked investors to trust the cycle. Let's quiz him a bit more on his views. Richard, it's great to have you on the show. Thanks very much for taking out the time. You know, talking about your outlook on emerging markets, you have stated that there are still plenty of reasons to worry about emerging markets, but valuations are keeping you optimistic. Do you feel emerging markets are pretty much at the bottom of their long-term average valuation range, perhaps even at the lower end of that range?
Well, it's always very difficult to say whether an asset class is actually at the bottom. But clearly, if you look at where valuations are in emerging market equities today and compare them to the last 20 years or so of history, we're clearly towards the low end of the historic valuation range. So whilst I think there are lots of things to worry about in emerging markets, valuation is clearly supportive.
Yeah, but especially on price to book, emerging markets are looking cheap at this point in time. In fact, they're closing into the 2008 crisis valuations as well.
On a price to book value basis, we are below historic averages. Some parts of the asset class are trading at 2008 level valuations, but not all across the asset class.
Then are you expecting a bounce from here? And if so, what will trigger the bounce? Can there be a case that the market really languishes here for the next 6 to 9 months?
Well, in the short term, the market appears to have found a bottom at around 1.5 times price to book. I don't think valuation on its own is enough to prompt a bounce in markets. So we need a positive catalyst in terms of some good news somewhere in emerging markets to reignite investor interest.
But the one question on everybody's mind is when will we see a decisive rally or resumption of a bull market within emerging markets at this point? Well, when will the EM versus DM trade tilt in the favor of emerging markets?
Well, the precise timing of a rally is obviously impossible to forecast. But we've had 6-9 months of underperformance by emerging markets now. I think as you move towards the end of the year, the outlook for emerging markets when people start thinking about 2014 will begin to improve. And certainly when we compare emerging market equities to the developed world, as we start thinking about 2014, I think that'll be the catalyst for investors to come back to the emerging market story. Normally, the fourth quarter of the year is a good period for emerging markets, and I think the same will be true this year.
You know, you have compared the recent fall to 2008, the crisis then. So rather than panicking, is it time to buy? You're saying that investors may lose money in the next 3 to 4 months as the turmoil in the market works itself out. But on a 1 to 3 year time period, emerging market shares, seem to be offering good value.
I think investors should always think on a 12 to 36 month time horizon. Clearly, emerging markets are a volatile asset class and they could be lower in 3 months than they are today. But if you think on a longer term time horizon, buying at this level has in the past been a successful investment strategy, and I don't really see why this time is going to be any different.
Right, you've also highlighted that you like high-income companies, dividend yield stocks, and consumer names, not the direct discretionary names, but something like car makers, autos. But my specific question over there is that aren't autos being impacted by the slowdown at this point in time? Isn't that consumption cycle in a downtrend?
The long-term opportunity in emerging markets is domestic consumption, and that's why companies like car companies and companies that pay higher dividends on a domestic franchise are places that I've invested in the past. Clearly those companies have been affected by the economic slowdown of the last few months, but I still think that they're going to be the first to recover as economic growth comes back to the emerging world, and I think that they're going to give investors long-term attractive returns.
You know, Richard, I was studying some of your funds, and your EM fund has outperformed the benchmark on a year-to-date basis. How have you managed to do so? What have you been buying or selling? What has been your cash strategy? And how have you managed the risk in currencies?
It's been a tough year for investing in emerging markets. And I think the key to successful performance has been focusing on higher quality companies across the emerging market world, trying to avoid countries that have had significant economic problems and currencies that have been particularly volatile. I think an emphasis on higher yielding stocks has been very helpful, and dividends, I think, are generally your friend at a time of uncertainty, and that's really what's characterized emerging markets in the first 6 months of this year.
Interesting, you have a contrarian view, and that too a bullish one on China and Brazil. Why is the conviction so strong for those regions?
Well, my optimistic view on China particularly, and to a lesser extent Brazil, has been very much driven by equity valuation rather than a particularly optimistic view about the economic outlook for either country in the short term. As we discussed earlier on, some parts of emerging markets, and I'd highlight Chinese equities here, are trading at 2008 crisis levels. And whilst there are lots of concerns about the outlook for the Chinese economy, I think equity markets are fully discounting those concerns, and that's why I think you're starting to see Chinese equities outperform at the moment.
Yeah, but your specific view on Brazil, because you're calling Brazil the 2014 investment story, so clearly you think that things would start looking up for the region from here on. Of course, that's also on the back that there's going to be the World Cup in 2014 in Brazil.
Well, I think Brazil has suffered from both the fall in commodity prices over the last 12 months and also the slowing economy. And as we move into 2014, not just because of the World Cup, but because of a general improvement in the economic outlook in Brazil and an improvement in domestic momentum, I think attention will switch back to Brazilian equities, which offer good value. And I think whilst China is probably a second half 2013 story, I'd expect Brazil to be a better performer in 2014.
Richard, what happens to EMs in the wake of a QE tapering?
The impact of QE tapering is going to affect all asset classes around the world, and emerging markets are certainly not excluded from that. I think, as we've seen in the last month or two, the most important impact in the emerging world is actually going to be on currencies. And as liquidity tightens, you've seen emerging market currencies weakening against the dollar, and perhaps more importantly being very volatile. And I think as investors become used to a tighter liquidity environment, that pressure on both currency and volatility will diminish. So as we move through the next 6 to 12 months, I think investors will get used to QE tapering.
And then, of course, the impact on EM currencies. What's the outlook there given the strength in the dollar?
We're in a period where the dollar is strengthening, primarily on the back of an improved performance by the US economy. That puts some pressure on emerging market currencies. But it's important to remember that there are 30 or so currencies in the emerging world. Some of them we think look overvalued. Some of them we think look extremely cheap. But I think the key issue is that an era of, or a period of rising US dollar tends to put the emerging markets under pressure. So you see weaker currencies underperforming and stronger countries and currencies tending to outperform.
How are you placing yourself across the EM basket? Where are you overweight or underweight at this point?
Well, when we think about weightings in the portfolio, we tend to have an emphasis towards the cheaper countries, particularly those with current account surpluses. So I would highlight China and Russia as key overweights at the moment. And we tend to be more skeptical about the very expensive parts of the asset class which have performed well over the last 12 months. So we're generally underweight the ASEAN countries in Southeast Asia, and we're underweight Mexico, which, although I think both of them look good from an economic standpoint, the equity markets are expensive.
Right. Do you think emerging markets are also entering into a rate tightening cycle? I mean, when do you see that happening on a conclusive basis? And what would that mean for overall risk appetite?
I think that rates are going up generally around the world, and EM markets are part of that. Rising rates tends to put pressure on weaker business models, so I think you should expect to see stronger companies outperforming, and it tends to make investors at the margin a little bit more cautious. So rising rates present a challenge for emerging markets. What we need to see and haven't seen over the last few months is rising rates combined with rising economic growth.
You know, even though inflation is not the big risk at this point, however, how are you mapping the outlook on inflation globally, whether it's in the US, UK, or emerging markets, given that there was so much liquidity in all these markets on account of an accommodative monetary policy?
I see inflation across the world as being a cyclical rather than a structural problem. There's clearly more inflationary pressure in the emerging world than there is in the developed world. But the fall in commodity prices has been helpful in keeping overall inflation levels subdued. So in general, inflation isn't something I'm terribly worried about right now.
Richard, what's the view on India? I mean, you found India attractive and pretty much in the middle of the EM pack. What's your view on the 10% up-down that we've been seeing, you know, the broad range of 5,500 to 6,100 that the market has been struggling with or trading within over the last 6 months?
Well, Indian equities have been volatile, although I think actually the key to the Indian story from an international investor's perspective is the currency rather than the domestic market itself. Historically, we've tended to find India expensive, and you're right, it's now trading in the middle of the pack and towards the low end of its historic valuation range, and that's a positive for long-term returns from Indian equities.
You know, despite all the macro concerns for India, the market is down 2% or so. Why is that? What is the outlook for the market going forward, given that we haven't fallen considerably from the start of the year till now?
Well, as I said, I think, you know, from a domestic perspective, Indian equities look cheap on a historic basis, and that's tended to support the market. Obviously, from an international perspective, returns have been much worse than that because of the fall in the currency. So I think when we think about where is India going to be in 12 or 24 months' time, you're actually saying where's the currency going to be? Now, I think the Indian rupee is undervalued currently, but there isn't a positive catalyst at the moment to turn around market sentiment.
Do you think the past 6 months, you know, all the policy measures that came out have helped India avert a ratings downgrade, or that's not the case?
I think there's still a chance for ratings downgrade. I think the RBI is very alert to that problem, but you can't rule the possibility out.
Okay, I want your views on the macro issues for India, whether it's a current account deficit, slowing growth, you know, inflation concerns due to the weak rupee.
I think in the short term, India is squeezed because the weak currency does feed pretty directly through to inflation, and I think that presents the RBI with a dilemma. But I think the key point to remember is that's a cyclical and consequently relatively short-term pressure, and I don't think it undermines the longer-term outlook for Indian equities.
Yeah, but do you think India is better off or worse off than other emerging markets, China, Brazil, Russia, Turkey for that matter? How would you rate India's ability to respond to local and global risks?
Well, India has got many key strengths compared to the other BRIC countries. It's a broadly diversified economy, it's got positive demographics, it's got a pretty stable democratic system. Those are all key strengths. It suffers, on the other hand, from a current account deficit, unlike some of the other BRIC countries. I think some of its domestic subsidy policies tend to exacerbate those problems. I don't really think it's right to make a comparison between the Indian and US situations, but I think India compares relatively favorably to the other BRIC countries.
You've spoken about the rupee being a key concern, Richard, and that it's undervalued. What's the outlook on the currency, and are FIIs looking to buy Indian equities in this currency fall?
The rupee is an undervalued currency, but I would have told you it was an undervalued currency a month ago, and valuation on its own isn't going to prevent the currency from falling. So in the short term, I'd expect further weakness. And I think that the RBI is acting to try to mitigate that weakness. Longer term, by which I mean looking out over 3 to 5 years' time from now, I think you'll see the rupee strengthening from where it is today.
Right, Richard, we have a new governor taking office September onwards. The much talked about issue is what happens with the rate cycle in India. Do you expect rate hikes in India? If so, how much and when? And if that were to happen, what would that do for the currency?
I think the RBI is keen to keep inflation under control and consequently is keen in the short term to support the currency. That means there is always the pressure for rates to go up. I'm not in the business of forecasting what the central bank is going to do in the short term, so when and how much they might raise rates, I really couldn't say. But there is clearly pressure on rates in the short term, and that'll be negative for equities.
Oh, Richard, you also run an emerging market infra fund where there is a 6% of exposure to Indian infra companies. Those companies have really gone to the cleaners, the kind of fall that we've seen, price damage in those stocks. What have you done with your holdings in Indian infra?
Well, the infrastructure sector, as you say, has been a tough place to be. And I think the key has been to hold on to high quality companies and get rid of companies that were more dependent upon a continued benign environment. So overall, we've reduced our exposure in the infrastructure sector.
The other sector that's much talked about in India is the banking space, which has been hammered out of shape. Are you buying into this weakness? Do you like Indian banks?
Well, Indian banks have had a very tough time in the last few months. We think that the Indian financial story is a structurally attractive one. Share prices have fallen very sharply in some names over the last few weeks, and we think that that represents a medium-term buying opportunity.
Well, given the focus on Brazil, which is really a commodity-led story, are you looking at commodity stocks in emerging markets and in India? They have been sold into considerably.
I've never been a believer in the relationship between growth in the emerging markets and rising commodity prices. So I'm not naturally a buyer of commodity stocks, which is something that's helped performance over the last 6 to 12 months. So I'm not particularly looking to increase exposure to commodity companies right now.
So then what have you been buying in India at this point or over the last 3 months in the market volatility?
I think when you look at India, you want to be exposed to really 2 parts of the market. One, you want to be exposed to domestic consumption. So we've been looking to increase exposure to the auto and the motorcycle sector as it's come under cyclical pressure. And secondly, you want to own globally competitive businesses. So we've been adding to positions in some of the IT service companies as well.
And lastly, Richard, it's a tricky time for India as policy initiatives stand the test of time with elections slated in 2014. What is your expectation of the event risk in your 2014 view on India?
Well, I think that the closer you get to the elections, the less likely there is that the government is going to do anything, and you'll increasingly become paralysed from a political perspective. Ironically, I think that actually reduces event risk. Once the election is out of the way, I mean, clearly we hope for a clear result one way or the other, and I think the worst outcome would be an uncertain result. But I don't think that the election per se is a significant event risk. I think that the democratic structure in India is a long-term source of stability.
Well, Richard, thanks very much for joining us with your views. Really appreciate your time today. With that, we come to the end of this edition of the FII View, but we leave you with a slice of opinion on the falling Indian market as well as the rupee, what FIIs are doing in this fall and what is their view on India for the near term.
In emerging markets generally, it's very patchy. Some markets are relatively expensive, some are not. It's interesting to note that in the BRIC area, BRIC countries have been pretty down, very unfavorable notices in terms of earnings and so forth in many cases. There we're finding some opportunities again. What we've seen is a flow of money going into emerging markets funds during the last 5-6 years in a pretty large amounts, with the exception of the subprime crisis. In the first half of this year, there's been a lot of money going into developed market funds, and emerging markets have been flat in terms of money flows. I think that'll be reversed because as profits are made in developed markets, as money flow begins to increase because the banks now are going to be flush with cash that they want to get out into the market, you'll see emerging markets come back.
From a long-term perspective, the case for being in Indian stocks is still very, very strong. The Indian government is clearly focused on its fiscal situation. The long-term outlook for growth in India remains very strong. It's an emerging market economy which is going to be growing on average much faster than developed market economies over the medium term. So I think the current weakness that we've seen in the Indian stock market is probably a pretty good opportunity to add with a view to building a position from a more strategic perspective.
We need strong growth in India, and you're just not hitting those numbers. We have seen the Indian rupee sitting now at around about 60 and a half, and I think if it continues what we've seen since really May of this year, it's been one-way traffic, and I think 62 and a half, 63 will be a headline number by October.
Measures which are aimed to try and stem the weakness of the currency but at the expense of growth, I think are seen as a retrograde step. I think it may well be the case that markets would take more heedance and more optimism from measures to try and enhance growth and push forward with structural measures which may not necessarily be the central bank's primary issue, but I think broader structural reforms I think will be much more beneficial to both growth and ultimately to the performance of the currency.